You know, there's something happening right now in markets that most retail investors are completely missing. And it's happening in the one stock that made more millionaires over the last 2 years than any other investment in history: Nvidia. From January 2023 to December 2024, Nvidia went up almost 10x. 10 times your money in 2 years. Extraordinary, historic, life-changing for anyone who got in early and held on. The AI revolution, the picks and shovels play, the perfect story at the perfect time. And retail investors? They're still buying. Reddit is bullish. YouTube is bullish. Financial Twitter is posting rocket emojis. But here's what I'm seeing from my position at BlackRock, managing over $11 trillion in assets, with access to institutional flow data, 13F filings, and conversations with the largest asset allocators on the planet. The smart money is selling. Not all of it, not panic selling, but quietly, systematically, methodically. The institutions that got in early, the hedge funds that rode the wave up, the pension funds that made billions, they're reducing their positions. And most retail investors have no idea it's happening. I want to be very clear about something. This is not a hit piece on Nvidia. This is not me saying, sell everything tomorrow. This is not me predicting a crash. What this is an analysis. A clear-eyed look at what's actually happening beneath the surface. A breakdown of institutional behavior that could save you from making a very expensive mistake. Because here's the thing about markets. By the time something becomes obvious to everyone, it's too late. The opportunity is gone. Or worse, you're the one holding the bag. Today I'm going to show you what the institutional selling data actually shows. Names, numbers, timelines. Why the smartest investors are reducing exposure now, not later. Where they're rotating that capital instead. What this means for Nvidia's future, both bull and bear case. And most importantly, what you should actually do with this information. This isn't about being right or wrong. This isn't about calling tops. This is about understanding the game, understanding who's on the other side of your trade, understanding what happens when the momentum reverses. Let's get into it. First, let's establish the facts. Let's talk about what Nvidia actually accomplished, because the story is remarkable. Nvidia was a $360 billion company at the start of 2023, already large. Already successful, dominant in GPUs for gaming, some exposure to data centers, professional visualization. A good company. But not a great investment for most of the 2010s. If you'd bought Nvidia in 2018 and held through 2022, you basically broke even. 5 years of nothing. Then ChatGPT launched in November 2022. And everything changed. From January 2023 to peak in late 2024, Nvidia went from roughly $150 per share to over $1,200, adjusting for the 10-for-1 split in June 2024. Market cap went from $360 billion to over $3 trillion. It became, briefly, the most valuable company on Earth. Revenue in fiscal 2024, $61 billion, up from $27 billion the year before. That's a 127% increase year over year. Data center revenue specifically, $47.5 billion, up 217% year over year. Gross margins, 75%. Operating margins, 62%. These are software-like margins on a hardware business. Unheard of. Every major tech company became a customer. Microsoft, Google, Amazon, Meta, Tesla, Oracle. They were all buying Nvidia chips as fast as Nvidia could manufacture them. Jensen Huang, Nvidia's CEO, became the most sought-after speaker at every tech conference. The leather jacket guy, the AI oracle. And the stock? It just kept going up, and up, and up. This created something very specific in markets. FOMO. Fear of missing out. I watched investors who'd never touched tech stocks suddenly putting 30%, 40%, 50% of their portfolios into Nvidia. I watched people taking money out of diversified index funds to buy individual Nvidia shares because AI is the future. I watched retail traders on margin buying call options, convinced this was the next Apple, the next Microsoft, the next chance to get rich.
And here's the thing. They weren't entirely wrong. AI is transformative. Nvidia does have a dominant position. The story was, and is, real. But something happened in markets that always happens during manias. Price disconnected from fundamentals. At its peak, Nvidia was trading at about 50 times forward earnings. For context, the S&P 500 trades at about 20 times forward earnings. Now, premium multiples make sense for premium growth. If Nvidia grows earnings 40% per year for the next 5 years, a 50x multiple is justified. But, and this is critical, that 40% growth isn't guaranteed. It's priced in. It's assumed. The stock already reflects that optimistic scenario, which means if growth comes in at 30% instead of 40%, the stock could fall 30 to 40% and still be fairly valued. That's not a crash. That's just math.
And that's what the smart money started calculating in mid to late 2024. Not, is Nvidia a good company? Yes, it is. But is Nvidia a good investment at this price? That's a different question. And increasingly, the answer from institutions was no. It's time to take profits. All right, let's get into the actual data. Because this isn't speculation. This is public information. 13F filings, institutional holdings disclosures, quarterly reports. Every institution managing over $100 million has to file a 13F with the SEC every quarter, disclosing their holdings. It's a 45-day lag, so it's not real time, but it shows the trend. And the trend in Q3 and Q4 of 2024? Selling. Let me give you some names and numbers. Stanley Druckenmiller from Duquesne Family Office reduced Nvidia position by 88% in Q3 2024. He'd been one of the biggest bulls, one of the earliest institutional buyers, and in one quarter he sold almost everything. His explanation in an interview, "I got greedy. I stayed too long. The valuation just got too extreme." Tiger Global sold their entire Nvidia stake in Q4 2024, about $1.5 billion worth. They'd held it for years, they made billions, and they exited completely. Soros Fund Management cut Nvidia holdings by 72% in Q3 2024. Appaloosa, that's David Tepper's fund, reduced by 58% in Q4 2024. Coatue Management, trimmed by 41%. Now, these are some of the most sophisticated hedge funds on the planet. They're not selling because they don't understand AI. They're selling because they understand valuations. But it's not just hedge funds.
It's also long-only institutions. Vanguard reduced Nvidia weighting in several actively managed funds. Fidelity, multiple fund managers trimmed positions. BlackRock, and yes, I should mention, we've also been reducing in certain strategies. Not eliminating, but trimming. Taking some profits. Rebalancing. Why? Because when a stock becomes 7% of the S&P 500 index, when it becomes the largest position in most portfolios, it's no longer a growth bet. It's a concentration risk. According to aggregate 13F data, Q2 2024, institutions held approximately $2.1 trillion of Nvidia combined. Q3 2024, down to $1.9 trillion. Q4 2024, down to $1.6 trillion.
That's $500 billion of institutional selling in 2 quarters. Now, the stock didn't crash during this period. Why? Because retail was buying everything institutions were selling. And because Nvidia was still being added to index funds as its weight in the S&P grew. But here's what's important. The marginal buyer changed. In 2023, the marginal buyer was smart money. Hedge funds, family offices, sophisticated institutions. By late 2024, the marginal buyer was retail. Individual investors, 401k auto contributions, passive index funds. And historically, when that flip happens, when smart money is selling and retail is buying, it's not a good sign for forward returns. From conversations I've had and public statements from fund managers, here are the main reasons. First, valuation. At 50 times forward earnings, the risk-reward is asymmetric. Downside, if growth disappoints, is 30 to 40%. Upside, if everything goes perfectly, is maybe 20 to 30%. That's not attractive. Second, competition. AMD is catching up in AI chips. Google is building custom TPUs. Amazon has Trainium and Inferentia chips. Microsoft is designing its own. The moat isn't as wide as it was. Third, customer concentration. Nvidia's top 5 customers account for about 45% of revenue. If any one of them slows spending or switches to in-house chips, that's a massive revenue hit. Fourth, cyclicality. Chip demand is cyclical. We've seen this movie before. 2000, 2008, 2018. Explosive growth, then sudden inventory correction. Nvidia isn't immune. Fifth, China risk. A huge chunk of Nvidia's revenue came from China, but with export restrictions tightening, that revenue is at risk. Sixth, law of large numbers. When you're a $3 trillion company, doubling again means becoming a $6 trillion company. That's bigger than the entire GDP of most countries. It's possible, but it's hard. Now, does this mean Nvidia is going to zero? No, absolutely not. Does it mean Nvidia is a bad company? No, it's an exceptional company. But it does mean that at current valuations, the smart money sees better risk-reward elsewhere. And that's what I'm seeing in the data. So if institutions are selling Nvidia, where's the money going? Because that's the real question, right? It's not enough to know what people are selling. You need to know what they're buying. And I can tell you, from flow data and 13F filings, the rotation is happening into 5 main areas. Rotation number 1, cash and short-term treasuries. This is the most common destination. About 30 to 40% of Nvidia profits are going into cash or cash equivalents. Why? Because at 4 to 5% yields on money markets and short-term treasuries, cash is competitive with equity returns on a risk-adjusted basis. Think about it. If Nvidia might return 10% next year, but with 40% volatility, versus cash returning 5% with zero volatility, on a Sharpe ratio basis, cash wins. Institutions are saying, I don't need to take big risk right now. I'll park money in cash, earn 5%, and wait for better opportunities. Rotation number 2. Defensive value stocks. The second big rotation is into boring, stable, dividend-paying value stocks that got completely ignored during the AI boom. Things like consumer staples, Procter & Gamble, Coca-Cola, Costco, healthcare, Johnson & Johnson, Merck, United Health, utilities, NextEra, Duke Energy, industrials, Caterpillar, Honeywell. These stocks are trading at 12 to 15 times earnings. They pay 2 to 3% dividends. They grow earnings 5 to 8% per year. Not exciting, but not risky. And when Nvidia is at 50 times earnings, a stock at 12 times earnings starts to look really attractive. Rotation number 3. International markets, especially China. This one surprises people, but it's real. A lot of Nvidia profits are rotating into Chinese equities. Why? Because Chinese stocks are cheap, really cheap. The CSI 300 index is trading at about 10 times earnings. That's a 50% discount to U.S. markets. And the Chinese government is stimulating. They're cutting rates. They're injecting liquidity. They're trying to revive their economy. Institutions are thinking, Nvidia gave me 10x in 2 years. Maybe China gives me 2x in 2 years. I'll take that bet with some of my profits. Rotation number 4. Private markets, infrastructure, and private credit. A lot of capital is moving out of public equities entirely and into private markets. Infrastructure, things like data centers, ironically supporting AI, power grids, renewable energy projects, toll roads, airports. Private credit, lending directly to middle-market companies at 8 to 12% yields, senior secured, floating rate. Why? Because these assets are less correlated to public markets. They generate steady cash flows, and they offer attractive risk-adjusted returns without the volatility of tech stocks. At BlackRock, we've seen massive inflows into our private infrastructure and private credit strategies in Q4 2024 and Q1 2025. A lot of that is Nvidia profits looking for a new home. Rotation number 5, other AI plays, broader beneficiaries. And finally, some money is staying in AI, but rotating from Nvidia specifically into other parts of the AI value chain, things like utilities and power companies. AI data centers need massive amounts of electricity. Cooling and infrastructure companies. Data centers need cooling. Software companies using AI like Salesforce, Adobe, Microsoft. Semiconductor equipment companies. ASML, Applied Materials. The thesis is, Nvidia is crowded. Everyone knows Nvidia. But these second-order beneficiaries are less obvious and potentially undervalued. So that's where the money is going. Cash, value stocks, international markets, private assets, and second-order AI plays. What you'll notice is that all of these destinations have something in common. Lower valuation risk than Nvidia at 50 times earnings. That's the theme.
It's not that institutions are bearish on growth or bearish on AI. They're just bearish on overpaying.
Now, let me be intellectually honest here, because I don't want this to be one-sided. There's a bull case for Nvidia, a very strong bull case, and I need to present it fairly. The bull case for Nvidia. First, AI is still early. We're in the first inning of the AI revolution, maybe second inning, but certainly not late. ChatGPT launched in November 2022. That's barely 2 years ago. The infrastructure build-out for AI is going to take a decade or more. Every company, every industry, every government is going to need AI infrastructure. And right now, Nvidia is the only company that can supply the chips at scale. So even if growth slows from 100% to 40%, that's still phenomenal growth. And it justifies a premium multiple. Second, the moat is real. Nvidia doesn't just make chips. They have CUDA, the software platform that every AI developer learns on, builds on, relies on. Switching from Nvidia to AMD or custom chips isn't just a hardware swap. It's a software rewrite. It's retraining developers. It's ecosystem lock-in. That moat is worth something. A lot, actually. Third, pricing power. Nvidia can charge almost whatever they want right now. Their customers will pay, because the alternative is falling behind in AI. That pricing power translates directly to margins, and high margins compound over time. Fourth, new products. Nvidia isn't static. They're launching new chip architectures like Blackwell and Rubin. They're expanding into automotive for self-driving. They're moving into robotics. The TAM, total addressable market, keeps expanding. So even as growth in data center chips slows, new revenue streams open up. Fifth, buybacks and dividends. At $3 trillion market cap, with 60+ billion in revenue and massive free cash flow, Nvidia can return tens of billions to shareholders through buybacks and dividends. That creates a floor under the stock. It attracts long-term value investors. It reduces share count, boosting EPS. So the bull case is, yes, valuation is high, but growth justifies it. And growth will continue for years. So hold on. Fair argument. But here's the bear case, and it's equally compelling. First, valuation leaves no room for error. At 50 times forward earnings, Nvidia has to execute perfectly, hit every earnings target, maintain margins, grow revenue 40% per year. If they miss even once, if revenue comes in 5% below estimates, the stock could drop 20 to 30%. That's not a good risk-reward. Second, competition is coming. AMD is catching up. Specifically, their MI300 chips are competitive with Nvidia's H100. More importantly, every major cloud provider is building custom chips. Google has TPUs. Amazon has Trainium and Inferentia. Microsoft is designing with AMD. Why? Because they're tired of paying Nvidia's prices. They want to control their own destiny. This is what always happens in tech. A company dominates, gets too expensive, and customers vertically integrate. Intel saw this with PCs. Cisco saw this with networking. Nvidia will see it with AI chips. Third,
Cyclicality is inevitable. Chip demand is cyclical. We saw this in 2000 with the telecom bubble. We saw it in 2008. We saw it in 2018 with crypto. There's a boom, then an inventory glut, then orders fall off a cliff. Right now, cloud providers are building out capacity like crazy. But at some point, they'll have enough. And when that happens, orders slow, revenue falls, the stock drops. Fourth, geopolitical risk with China. The U.S. government has restricted Nvidia's ability to sell high-end chips to China. That's a huge market that's now limited. And if tensions escalate, those restrictions could tighten further. Or China could retaliate in other ways. Geopolitical risk doesn't show up in earnings estimates, but it's real.
Fifth, the law of large numbers. This is the simplest bear case. Nvidia is already $3 trillion. To double from here, it needs to become 6 trillion. For context, that would make it bigger than the GDP of Japan, the third largest economy in the world. Is it possible? Maybe, but it's hard, really hard. My assessment: both cases are valid. This isn't black and white. But here's how I think about it. The bull case requires everything to go right. The bear case just requires things to go normally. And in my experience, things going normally is more likely than things going perfectly. That doesn't mean sell everything. It means be realistic about risk. All right, so what does this mean for you? What should you actually do with your Nvidia position, if you have one? Let me give you a framework. Not financial advice, a framework for thinking clearly about this decision. Question 1. How much of your portfolio is Nvidia? If Nvidia is less than 5% of your portfolio, honestly, you can probably just hold. It's not a concentration risk. Even if it drops 50%, that's only a 2.5% hit to your total portfolio. Painful, but not catastrophic. But if Nvidia is 20%, 30%, 40% of your portfolio because it went up so much and you didn't rebalance, you have a problem. That's not a portfolio, that's a bet, a single stock bet. And single stock bets, even on great companies, are risky. So, first step, know your actual exposure. Question 2. What's your cost basis? If you bought Nvidia at $200 per share pre-split, and it's now at $1,000 plus, you're up 5x. You've won. Take some profits. I don't care how bullish you are on AI. I don't care how much you believe in Jensen Huang. You don't let a 5x winner turn back into a 2x winner because you got greedy. Trim. Take out your initial investment. Let the rest ride if you want. But lock in some gains. If you bought recently at $800, $900, $1,000 per share, you're in a different situation. You don't have big gains to protect, and selling at a small loss might not make sense. But you should ask yourself, would I buy more at this price? If the answer is no, then why are you holding? Question 3. What's your time horizon? If you're 25 years old and investing for retirement in 40 years, you can afford to hold through volatility. Nvidia could drop 50% and recover over the next decade. You have time. But if you're 60 years old and this is your retirement money, you cannot afford a 50% drawdown. You need to de-risk.
Time horizon matters. Question 4. What's your alternative? This is the most important question. If you sell Nvidia, what are you buying instead? If your answer is cash because I'm scared, that's an emotional decision, not a strategic one. But if your answer is, I'm rotating into undervalued healthcare stocks and international markets because the risk-reward is better, that's strategic. Don't sell just to sell. Sell because you have a better idea. Here's what I'd suggest for most investors. If Nvidia is more than 10% of your portfolio, trim it down to 5 to 7%. Take profits, rebalance. If you're up more than 3x, sell at least your initial investment. Let the rest ride. If you bought recently and don't have big gains, hold, but don't add more. This is not the time to double down. If you're in a tax-advantaged account like an IRA or 401k, you can sell without tax consequences, so trimming is easier. Do it. If you're in a taxable account, consider tax implications. If you're sitting on huge short-term capital gains, maybe wait until they become long-term. But don't let the tax tail wag the investment dog. And most importantly, diversify the profits. Don't sell Nvidia and buy another single stock. Don't sell Nvidia and buy crypto. Don't concentrate risk somewhere else. If you sell Nvidia, rotate into broad index funds like VTI or VOO, international markets like VEA or VWO, value stocks or defensive sectors, cash for dry powder, maybe some alternatives like gold, tips, private credit if you have access. Spread it out. Reduce concentration risk. For transparency, I don't hold individual stocks in my personal portfolio. I'm almost entirely in index funds and alternatives. But at BlackRock, in strategies I oversee, we've been trimming Nvidia since late 2024. Not eliminating, trimming. We took it from about 6 to 7% of certain portfolios down to 3 to 4%, and we rotated that capital into value, international, and private markets. Is that the right call? Time will tell. Maybe Nvidia goes up another 50% and I'll look like an idiot. But from a risk management perspective, from a portfolio construction perspective, it's the right move. Because my job isn't to maximize returns. It's to manage risk and generate reasonable returns over long periods. And Nvidia at 50 times earnings, at 7% of the S&P 500, representing $3 trillion in market cap, that's a concentration risk I don't want to take. Let me close with some perspective. Because this isn't the first time we've seen this movie. Cisco in 2000. At the peak of the dot-com bubble, Cisco was the most valuable company in the world, $555 billion market cap. Everyone said, the Internet is the future, and Cisco is the infrastructure. They were right about the Internet, but Cisco's stock dropped 90% and took 15 years to recover to its 2000 highs. Why? Because the valuation was insane. 150 times earnings. Intel, in the 2000s, dominated the PC chip market. Everyone said, computing is the future, and Intel is the infrastructure. Again, they were right about computing. But Intel stock went sideways for a decade because the valuation got too high and competition emerged. Nvidia today. Could this be different? Could Nvidia be the exception?
Maybe. AI might be bigger than the internet. Nvidia's moat might be stronger than Cisco's. But history suggests that when a stock becomes everyone's consensus best idea, when valuation gets extreme, when retail is buying and institutions are selling, the forward returns are usually disappointing. Not because the company fails, but because the bar is too high. So my message to you is this. Nvidia is an incredible company. Jensen Huang is a visionary CEO. AI is transformative. The bull case is real. But don't confuse a great company with a great investment at any price. The smart money isn't selling because they think Nvidia is going to zero. They're selling because they think the risk-reward is unattractive at current valuations. And if you've made a lot of money on Nvidia, congratulations. Truly, that's a huge win. But don't give it all back by getting greedy. Take some profits, diversify, reduce concentration, protect what you've built. Because at the end of the day, investing isn't about being right. It's about managing risk. It's about surviving long enough to compound. And concentration is the enemy of compounding. That's the lesson from history. That's what the smart money knows. And that's what I'm seeing in the data right now.